Friday, January 5th, 2024, Monaco 64, home of alternative economics and contrarian views. So banks are the most important financial institutions, really, in a fiat currency system, especially one in which we find ourselves so stretched with so much debt and credit. Not just corporations, individuals, but especially the government, seeing that the U.S. national debt just topped 34 trillion. It's expected to go to 35 trillion by the end of March. So yes, I think the banks could be keeling over again, and interest rates or long-term bond yields are the key to that, in my opinion. And we're also going to be looking at the BTFP, the facility the Fed had to start up back in March of 2023 to stabilize the regional banks. There are some worrying signs coming from that part, also from the reverse repo. And you might ask, what can they do to allay fears of a crisis or to stop a crisis? Well, we're going to look at that in a minute. Before we do, though, I just wanted to let you know that Miles Franklin, one of my two U.S. affiliates, precious metals dealer affiliates, has some interesting specials this week. They have a quarter of an ounce gold eagles only for $65 over melt. They also have 1 ounce silver Noah's Ark coins, $3.49 over spot. And for those of you who are into politics, they even have a 1 ounce silver Trump bar, and that's only $3.15 over spot. So just wanted to put that out there. If you're interested, contact at info@milesfranklin.com through email. There's also this 1-800 number that you can contact and let them know that Mario or Monaco 64 sent you. So back to the banks. And back in 2008, it was the banks, especially the Wall Street banks, that almost brought everything down. It wasn't a mainstream crisis. It was a derivatives crisis, and the subprime. Watch The Big Short, and you understand what happened there. And I think we're still paying for it. That's when we went down the road of massive QE. And as I've said many times before, once you go down that road of inflating the currency, because that's what QE is. Of course, there are many out there who think QE is deflationary. I think they need to wake up. You can't stop. And historically, we've seen that. And America, the UK, the West are not immune to the laws of nature. And I've spoken about fiat money inflation in France by Andrew Dixon White. And that's what they try to do with the assignats in the revolutionary period in France. They started their QE and they said, we're only going to do one issue and then it's going to kickstart the economy and we're going to stop. But it ended in tears. The assignats collapsed after many issues. They tried the mandats. That didn't even get off the ground. And I think QE is the same thing. Human nature never changes. And yes, the banks started this out through their derivatives shenanigans. The Clinton administration, I think, was a big part of the problem because Bill Clinton signed the abolition of Glass-Steagall into law, allowing commercial banks to deal as investment banks. So that rule that had been in place since the Great Depression allowed banks that hold your deposits to speculate with it. And even under the Obama administration, a lot of the derivatives out there can be, they can use depositors' money to back it. So it's a house of cards. The derivatives problem hasn't been solved. But what's been happening now as well, because to keep this policy of QE, or the result of this policy of QE, was artificially low interest rates since 0809 up until a couple of years ago. They kept rates at zero, central banks, their policy rates. Bond yields were also below 2%. In Europe, they even went negative at one point. We had 17 trillion in negative yielding bonds. And people might ask, why would you buy a negative yielding bond? Well, because the more negative the yield becomes, the higher and quicker the price goes. So bonds became speculative. And now with the problem that prices are rising, consumer prices, the inflation is showing up through rising prices. Central banks were forced to raise rates quite aggressively. And what that is doing, that's putting pressure on the price of all these bonds that were highly speculative. And a lot of the regional banks, a lot of the big banks, they hold these bonds as assets in order to cover their liabilities, i.e. the deposits that you leave with them. And the other thing they do, of course, banks, they leverage to the hilt. That's the nature of the fractional reserve banking. So that's what's going on. And that's why I've been out of the banking system. Of course, not totally. I need to have some unsecured loans, make some unsecured loans to the banks, which basically means to leave some money in the bank, because the money in the bank is not really yours. It's an unsecured loan to cover expenses, tax expenses, and everything else. But I've been getting out of this system ever since '02, when I learned about the importance of gold in the system. And that's why I've been stacking gold and also silver. But so let's get back to the banks, because back in March last year, things were, you had SVB fail and some other regional banks, and the Fed had to come in with this BTFP, which is Liquidity and Credit Facilities, Loans, Bank Term Funding Program. So what was this all about? Well, what happened with SVB is that some of the big depositors, some people argue that Peter Thiel, who's a billionaire, started worrying because he saw that the bank's balance sheets were underwater because they held treasuries, and as yields are going up very quickly, the value of their assets were going down. And they panicked and they rushed to move their money out from SVB to maybe JP Morgan. And they did it all online. So there was an online run. And what the Fed did is it told all the other banks that were in the same situation that they would lend them money for those crappy treasury holdings that were losing value very quickly. But, let's say a treasury was worth 70 cents. The Fed said they would value it at 100 cents and they would borrow at favorable rates. And that's what the BTFP is. So as you can see here, it shot right up from March to April, up to 80 billion. But now it's almost doubled since then. And it's really picking up since November. And right now we're at 141 billion. It might not sound a lot, but again, these banks borrow this and they hypothecate it. They do fractional reserve lending. So this number could be even bigger. And despite the fact that the Fed has been doing QT, this is kind of neutralizing it. And we're also seeing that China, their central bank, is doing a lot of QE. I think they've done 600 billion in the last 12 months, as you can see here. But what I would say, I think we're at a breaking point for the banks. There are two indices that you can follow. There's the KBW NASDAQ Bank Index, and that has more of the bigger banks. And if you look at the chart, it's picked up from October, but it looks like it's keeling over a little bit, and it's really the trend since, let's say, January 2022 seems to be lower, so you need to keep an eye on that. The KRE, that's probably a very important one. It's the regional banking ETF, and you can see that in March 2023, it made or May 2023, it made a low that almost matched the low during the pandemic, and that also seems to be keeling over. So we need to keep an eye on that. In my opinion, we're also seeing the reverse repo, even though it jumped a lot at the end of the year, it's now come right back down. And that's a problem, of course, for the Treasury, because it's helping the Treasury finance its huge deficits and its debt issuance. And many people think this could be down to zero by maybe February, March. So that could be a trouble ahead as well. And I spoke about bond yields and the fact that it looks like long-term bond yields are picking back up again. And that's why today as well, with the non-farm payroll or jobs data coming out at 8:30 Eastern time, I think that could set the tone for the next few months for yields. But it looks like the market is forecasting, something that will make bond yields go up, because we're already turning up here. We had a very sharp correction in what I think is a long-term bear market in bonds. And this is going up because it's the yield. And most of you know that when investors sell bonds, the yield in the bonds go up. It's the same thing with stocks. When the stock price goes down, if you have a dividend paying stock, the dividend yield goes up. So it looks to me like, this relief we've had since, let's see, the end of October in the bond market, that could be coming to an end. And that's why it's going to be important to watch the jobs data today. If it's a strong number, we could see that go up even more. But we also need to keep an eye on other data that are coming forward in the future. It's not just one data, of course, that's going to change things. And also things like U.S. Treasury auctions. If investors don't really show much appetite for that, we could continue to see these yields go up. And I think the other thing that could be pointing to a recession is that if the long-term yield, like the 10-year, keeps going up, I think we're going to see it go through the 2-year. So it's going to disinvert. And usually that's a sign that a recession has started. We got very close to disinverting prior to this rally in the long end back in October. So we need to keep an eye on all of that. And I think the banking sector, yes, that's at the heart of the problem. Of course, there are some people speculate a quadrillion in derivatives, notional derivatives, and the banks are the ones that hold most of it, especially the too big to fail Wall Street banks. So what would they use as a crisis, in my opinion? Because I think back in 2020, the crisis had started already with the repo crisis in September of 2019. And they used the pandemic as a cover, as an excuse to print, to cut rates. Well, there's a lot of talk about cyber pandemics. And I spoke with Mike yesterday. We did the Mike and Mario show yesterday because of scheduling conflicts. And even the ECB now is doing stress tests for, a cyber attack. We saw that movie. I mean, I don't know if you've heard of it on Netflix. It's a movie produced by Barack and Michelle Obama. And it's about a scenario where, you know, it's called Leave the World Behind. I would watch that. If there ever was predictive programming, that this is the movie, and this is, and they would blame, of course, the Russians or the Chinese for a cyber attack, and it completely disrupted everything because we're so dependent on online, on internet for everything. So that's how I see it. This is just speculation, of course. And does it mean that if bond yields are going up, that the economy is doing well? I don't think so, because I think we're in a stagflationary environment. And most, of course, mainstream economists and mainstream media commentators, they can't see the economy slowing down and yields and prices rising, and it's the same mistake people made in the 70s. They couldn't see, the Keynesians didn't understand that you could have stagflation, which is basically when you debase the currency so much, you slow everything down, and people become worse off. And the reason they don't see it, I think, is because they don't know the nature of money. You know, they haven't looked at the Austrian school theory, regression theorem of money, where you go back and you realize that money is just a most marketable commodity. And when the government takes over money and starts saying that a piece of paper or a promise is money, and they can make, print that as much as possible, it becomes worth less if the economy isn't doing well. And to keep it going as well, this Keynesian paradigm, the government always grows, and now government has grown so much, and it's irreversible in my opinion. So yes, I'll stop here. Keep an eye on the banks, keep an eye on bond yields, keep an eye especially on the data today. And we're going to look at the markets right now. So it's 8:43 a.m. London time. We've got spot gold pretty much unchanged at 2,043. The high's been 48, the low's been 40. Silver's up a few cents. It's just above $23. High's been 21. The low has been 22.97. The stock market indices are all slightly lower. I won't go through them. They're virtually unchanged. Sterling is down slightly at 126.72. The euro is down 1/3%. I think we had some very weak German retail sales, which is not encouraging for the whole of Europe, the UK included, because Germany is the biggest economy in Europe. So the euro is at 109.10. The dollar is up 1/3% versus the yen at 145.04. Dollar's down 1/8 versus the Chinese yuan at 716, and dollar's up slightly here versus the Swiss franc, just above 85. Let's check the other currencies. We've got the Aussie dollar down 0.2, just below 67. The dollar's up 1/10 versus the Canadian dollar, 133.62. And the Kiwi dollar is down slightly at 62.24. To the commodities, WTI crude is back up. We're at 72.61, up 0.5%. Brent is up 1/3, just below 78. And platinum is down $10 actually, trading around 950. And as I said earlier, the 10-year yield has been rising to start the year, and we're now back above 4%. We're at 402. So with that, I'm going to wish you all a very good day, a very good weekend. Take care. Bye.